From my experience, retail investing is really hard to do. Many times, people start out wanting to do good and make money by investing in the stock market rather than throwing money at Ponzi schemes. But in the end, they find out that it's not the easiest thing to do. They end up investing a lot of money and giving up before they have achieved any real progress. In this video, I acknowledge this fact and I try to explore some of the reasons why investing in the stock market can be difficult for starters. And hopefully at the end of the video, I will provide some solutions to get you started. The reason number one is the right information. Now, if you're going to invest in the right way, you need the right information to help you make the right choice. In this context, some of the first information that a retail investor needs are the financial statements, the current and the historic ones, some ratio analysis, and of course, you need to arrive at a fair price to pay for the shares. But that can't be all the information you need. And if you think of information or investing rather as a team sport, then we should realize that more often than not, the team with the best strategy will win the match. It is clearly possible that the little guy will upset the big teams, but that happens once in a while. And any advantage is going to be unsustainable over the long run. So, with thousands of businesses listed on the stock market, how do you even begin to filter out the companies that offer the best value for your money? Now, there are tools that help you do this. We have Capital IQ and we have the Bloomberg Terminal. These tools help people quickly zoom in on information from a large list of companies based on specified criteria. However, the Bloomberg Terminal costs about $24,000. Capital IQ costs about $13,000 just for an annual subscription. So, with subscription to some of the best tools which offer the highest quality information at crazy prices, the game almost seems to be rigged against the retail investor who only has a few $100s to invest per time. This means that an average investor will often make his stock picks from analyst reports, Twitter feeds, Telegram groups, or even Reddit. Now, the information on this platform often contain a lot of noise as you cannot decipher the motivations of many people posting on these platforms, right? So this can lead you to making an emotional decision rather than a decision that is based on sound logic. Now, to overcome this limitation, this evident limitation, I would suggest that when you're doing your research, you can classify your information sources into high quality and low quality sources. What do I mean by high quality sources? High quality sources will include the current news about the company, the management discussions in the annual report, and all those informations that I think can be from verifiable sources. Whereas information from Reddit, Telegram, Twitter feeds, and the likes can be classified as low quality data. If you can do this successfully, then you should be able to make a decision to invest or not, a high quality decision to invest or not. All right. Number two reason is hard work. Now, I am not against hard work, and it is often said that hard work compounds like interest. And the earlier you do it, the more time you have to benefit from it, right? Now, without high quality information, which is already aggregated, retail investing will take a lot of time because you have to gather and compile your own information. This can clearly be a very strenuous activity, especially given that many people will only be investing a tiny amount per time. The amount involved may not even justify the effort required to perform a detailed analysis anyway. However, there are free tools such as Yahoo and Google Finance, and these tools compile information to aid faster decision making. Obviously, you would still need to combine this information with other sources of data. And of course, the speed at which you make sense of this information will depend on a developed ability to understand financial information. And in reality, not many retail investors will have this ability at the initial stage. Now, there is no shortcut here, although I strongly believe that when you invest some time to develop this skill, you would over time be able to spot great companies quicker in the future. So hopefully this should reduce the amount of work required in the future. All right, if you're enjoying this video, I will appreciate it if you can smash the like button. You can also subscribe if you're yet to subscribe to the channel. I'll really appreciate that. The third reason is the potential for limited outsized returns. Now, if you're anything like me, I dream of a big payday all the time. However, I do not think there are many opportunities with the potential for outsized returns available to the retail investor. And of course, if they exist, we already mentioned how difficult it is to spot, given that the best way to spot them are hidden behind huge paywalls. Oftentimes, only smart money are able to invest in companies at the initial stages, and many of these companies even seek out this smart money. Because these people bring more than money to the table, they also bring their connections and they take an enormous risk on the project long before it reaches product market fit. For example, that's Coinbase, IPO'd around $330 per share in April 2021. And many retail investors like me scrambled to add the stock to our portfolio. The share price of the business has since fallen from those highs. However, the real winners already made 6,000 times their initial investment when the stock IPO'd. Gary Tan posted a video where his firm, Initialized, was able to buy the same shares at 15 cents as one of the earliest investors in the business. This singular investment has netted his firm billions, which is more than any retail investor can dream of. I don't think this should dissuade you from investing though. Just like the smart money lose a lot of money in the course of their investing career, they bank on the businesses whose gain will cover those many losses. So I think this should also be true for retail investors. The fourth reason is scale. Now, for retail investors, investing all our net worth in a single business might be very risky. And this is something I would not advise anyone to do. Yet it's this high exposure to a single company that is likely to generate above market returns. Many retail investors like myself only have a few hundreds of dollars to invest at any one time, and we often try to invest in multiple businesses at the same time. This means that any huge increase in the share price of a single business in our portfolio may not lead to increases or significant increase in our net worth, since we have limited exposure to that shares. Now, I think it is important to maintain a balance in allocating your portfolio so that you can benefit from the gains in the movement of a single stock while also diversifying your interest in things like the S&P 500. An example of an investment in a single company that can go wrong is Nikola. Now, with the whole stock market being bullish on EV, electric vehicles, shares such as Tesla, many people expected and even bet that Nikola will reach some of those levels being seen by Tesla. Unfortunately, a report by a short seller and mainstream media poked holes in the business valuation, and the share price has not recovered to the previous levels. So, on this note, I wish you well in your investment decisions, and I hope that you are able to make better decisions as a retail investor. Also, I would like to state that these are just my opinions and they do not represent any personalized financial advice. If you like this kind of content, a like and a subscribe to the channel would be well appreciated. And then I'll see you guys next time around. Until then, please have fun. Bye.